Accounting Standard 11 Revised. Accounting for effects of changes in foreign exchange rates. Applicable to all enterprises for which accounting period commences on or after 1 April 2004. It is applicable to transactions in foreign currency and translating financial statements of foreign subsidiary branches. Monetary items denominated in foreign currency shall be reported using closing rates. Non-monetary items carried in terms of historical cost in foreign currency shall be reported at the exchange rate on the date of the transaction. Exchange differences shall be recognized as income expenses in the period in which they arise, except in case of fixed assets and differences on account of forward contracts. Translation of foreign exchange transaction of revenue items except opening, closing inventories and depreciation shall be made by applying rate at the date of the transactions. For convenience purposes, an average rate or weighted average rate may be used provided it approximates the rate of exchange. Opening and closing inventories shall be translated at rates prevalent on opening and closing dates, respectively, and depreciation amount shall be converted by applying the rate used for translation of the asset. Translation gains and losses for branches, subsidiaries forming integral part of operations of the entity shall be accounted as stated in above. However, translation gains and losses for non-integral operations shall be directly credited to reserves. It may be mentioned that the method of arriving translation gains or losses shall be different from that stated above. For example, all assets and liabilities are converted at closing rates and revenue items are converted at average rates, where it approximates the rates at the date of transactions. Integral foreign operation is a foreign operation, the activities of which are an integral foreign operation is a foreign operation, the activities of which are an integral part of those of the reporting enterprise. Exchange differences arising on repayment of liabilities incurred for purchase of fixed assets shall be expensed through profit and loss account. Note: in case of a company read as required by Schedule 6, where the fixed asset is purchased from outside India, the related exchange gains and loss, if any, are required to be capitalized. Also, in case of a company, other exchange differences arising out of long-term monetary items can be initially deferred and later amortized over the period up to March 31, 2012, or the life of the related long-term monetary asset, whichever is lower, with corresponding adjustments in balance sheet. Through foreign currency monetary item translation difference account, gains or losses on accounting of forward contracts is recognized through profit and loss account unless it relates to fixed assets as described in above for a company. However, measurement of gains or losses on forward contract depends upon the intention for which it is taken. Where it is not for trading or speculative purposes, the premium discount is amortized over the term of the contracts. Where these are held for either speculative or trading purposes, the gain or loss is arrived at each reporting date after comparing the fair value of contract for its remaining term of maturity with the carrying amount at the reporting date. Profit, loss on cancellation or renewal of forward exchange contract shall be recognized as income expenses of the respective period unless it relates to fixed assets as described in above for a company. Amount of exchange difference included in profit or loss account adjusted in carrying forward, or amount of fixed assets or due to forward contracts recognized in profit or loss account for one or more accounting period must be disclosed.